Thank you all for tuning in to WJC 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I'm a licensed certified public accountant in the state of Illinois. I'm a licensed, I'm the owner and practitioner of my firm, Badu Tax Services, and we specialize in tax preparation, tax planning, and tax representation for individuals and businesses. So today's topic is essentially a recap on the markets. So we will talk about what happened in the stock market in 2018. Unfortunately, we did have a bad year, first year since 2009 or so that we were actually down in the stock market. So something very important to watch out for. We'll be going through a few recaps. I'll be reading some reports, some things that happened. As I'm reading, I will also be summarizing. So something very important to pay attention to. We'll be going on for about 40 minutes or so, just giving you guys what happened in the markets and ultimately thinking ahead as well. Just talking about things that are going to happen in 2019 and moving forward. And we will not do a market report for this past week since we are doing an overall market analysis for the entire year. So something very important to look out for as well. So here we go. So in 2018, it was one of the craziest years out there as far as the markets are concerned, as far as stocks are concerned, as far as bonds. Basically, everything was down. So let's look at exactly what happened, like what actually happened in the markets last year. Why were the markets down? This is very important to know. So with that being said, trade wars, midterm elections, and market volatility highlighted 2018 for investors. There was a lot of volatility. Volatility meaning changes in the market. In an attempt to reduce the trade deficit, President Trump pushed to rewrite trade agreements that certainly had an impact on the markets. So when you rewrite trade agreements, that always has an impact because it affects the way that U.S. and other businesses do business all around. But he essentially pushed to rewrite several trade agreements with longtime partners of the United States. So he amended the trade agreement with countries such as South Korea, imposed tariffs on steel and aluminum. That has a huge impact on the markets. And renegotiated the North American Free Trade Agreement, now called the United States, Mexico, and Canada Agreement. But the trade war with China has been the most compelling and impactful, not only to the countries directly involved, but to much of the global economy. Reciprocal tariffs were imposed by each economic giant throughout the year. And there was a temporary truce achieved following the Group of 20 summit, but there was no definitive agreement reached. So one thing that happened this year, or in 2018, was a lot of trade agreements, renegotiations, and different things like that. That always has an impact on the markets and the economy as a whole. Now, elections in November, we did have a big election year. Every 2 years we go through elections with the House of Representatives and the Senate. So elections in November showed how politically divided the nation is. So very big. Politics also had to do with it. So the first thing we have was trade agreements. And then the second thing we have that affected the markets, why the markets were down in 2018 was a lot of politics. Democrats picked up 40 congressional seats to win control of the House of Representatives for the first time since 2011. On the other hand, Republicans maintain control of the Senate, so you still have a divide between the Democrats and Republicans. The end result is a Congress that has become even more divided, as if we needed more of this. But at least politically, Congress is essentially divided, and that's probably why you see a government shutdown right now, which has been going on for exactly 30 days as we speak. And then the federal government, of course, here's where we get into. The federal government shut down in late December due to a budgetary statement or stalemate between President Trump and Congress, principally over funding over a border wall. So that's why we're in a shutdown right now is because our president wants a wall, and a lot of people in Congress do not want a wall. So now we have this debate, and to this day, on January 21st, 2019, our government it's still shut down. So let's keep going. For the year, the stock market reached new highs. So we started off really, really high. I mean, we were just skyrocketed. It would have been a beautiful year had it not been for all these tariffs and things like that, and gave it all back by the end of December. So we started very high and then we just dropped. Volatility is the word that best describes the market in 2018. That goes without saying. Despite the economy expanding at a rate not seen in many years, so we had a great year from an economical standpoint. But favorable, so we had favorable corporate earnings as well, which is pretty good. Or favorable corporate earnings reports, strong consumer spending, tepid inflation, plenty of jobs to be had. So we expanded the economy a little bit. Stocks still somehow managed to go down. Reason: trade wars continued. The Federal Reserve continued to increase interest rates. Oil prices bottomed out. And then long-term bond prices also rose. The Chicago Board Options Exchange, CBOE for short, Volatility Index, which provides a measure of market risk and investor sentiments, spiked in February, then was relatively stable through much of the summer. However, by the end of December, the VIX jumped again, and then stocks were sold. So there was a big stock sell-off throughout the year. Bought, sold again in rapid order, causing benchmark indexes to post noteworthy gains and losses on an almost daily basis. As a result, investors rode a roller coaster. So we had an up and down market. They rode a roller coaster of stock prices throughout the year. So very, very volatile market in 2018. A lot of changes, trade wars, change in Congress, the government shutdown. There's just a lot of different things that happen. Interest rates being hiked, but at an extensive rate. Now the Federal Reserve has slowed down because they understood that they didn't want the stock market to keep going down, so they did not raise interest rates in December. So the year saw some positive highlights as well. The economy expanded at an annual rate exceeding 3% for the first time in several years. So as you can see, the economy is actually doing well, but the stock market didn't do so well in 2018. Even the unemployment rate hit the lowest mark since 1969. I mean, that is incredible. In November, 1.7 million people were marginally attached to the labor force, an increase of 197,000 from a year earlier. That is powerful. The Federal Reserve, based on the strength of the economy and the labor market, as they should do, they raise interest rates 4 times during the year. So that's something that's something that's very you should pay very close attention to, is that the Federal Reserve actually increased interest rates four times throughout the year last year, which means that the economy is doing pretty well. Anytime they increase interest rates, it usually means that the economy is doing pretty well. And then consumer income rose, and purchases increased. So people made more money, and they bought more stuff. And inflation exceeded 2% mid-year, only to fall back below the target by the end of 2018. So as you can see, we had so many things happening. Economy doing well, separation in Congress, or a divide in Congress, government shutdown. We had so much stuff going on. So it caused too much volatility. I mean, investors, their hearts were just pounding. So some people were forced to sell. But overall, here's what happened. So the Dow Jones index ultimately was down 5.63% in 2018, which is big. That means that the Dow Jones went down just about 6% or so. The NASDAQ, which runs basically all the top tech companies in the world, even the NASDAQ was down 3.88%. S&P 500, the top 500 companies in the U.S., was down 6.24%. Russell 2000 down 12.18%. Global Dow, the entire global market, 11%. And how did this happen? It's mainly because of what happened in the fourth quarter of the year. The Dow Jones was down 11.83%. NASDAQ down 17.54%. I mean, that is huge. That means tech stocks in the fourth quarter of the year were down 17.54%. S&P 500 down 13.97%. Russell 2000 down 20.51%. Man, that is huge. Global Dow down 12.33% in the fourth quarter. And then federal funds rate. So they actually, just a quick correction, in the fourth quarter, there was actually an interest rate increase of 25 basis points, meaning that interest rates went up by 0.25%. Overall, interest rates last year in 2018 went up 1%, which is a sign that the economy is doing pretty well. In 2017, we were at 1.25 to 1.5%. In 2018, we're now at 2.25 to 2.5%. So that is one big reason why the markets were down in 2018, is because we just couldn't handle the amount of interest rate increases that were happening. It was just way too rapid. Investors got scared. Companies were probably borrowing less money. People in general were borrowing less money, especially to buy homes and things like that. So overall, the Federal Reserve has a lot to do with why the economy, or not the economy, but the markets in general. The economy did well, but the markets in general actually went down in 2018. Now, I would say in 2019, we're off to a very fast start, just like we did in 2018. We're up so far. In 2019, we're doing really, really well, actually. Hopefully, that continues. That's always good news for investors. But who knows what can happen? Who knows how long the government is going to be shut down? Who knows if the president is going to be impeached or not? Nobody knows anything at this point. However, we could use information like this and use it to our advantage. We know that the market, basically went down. One big reason was because the Federal Reserve increased interest rates. And knowing the Federal Reserve, they're very, very conservative. So I would highly doubt that they they hiked any interest rates this year, just because of what happened last year in the markets. The very first time that we've had a stock market, a stock market that went down in about 10 years or so. The very, very first time in 10 years. So let's get a little deeper into exactly what happened. So we talked about the overall economy, or what happened overall in the economical environment. Now let's get a little specific as far as what happened in each of the different markets in general. So here we go. In equities, or stocks, let's just say, the year 2018 may ultimately mark the end of what was nearly a 10-year bull run. In 10 years, we just kept going up. We just kept going up just like that. So in 10 years, we had essentially 2018 was the very first time that the markets were down in essentially 10 years. The last time we seen the market down was in 2009, ultimately, when stocks were basically, back in 2008 and 2009, there was a huge downfall. And so really the last time stocks were down was back in the 2008, 2009 days. So we were on a run. We were on a bull run. Basically, when stocks go up, that's called a bull run. So we were on a almost 10-year bull run. At the start of the year, January was a good month. It was a great month, actually. I mean, we were up, I believe we were almost double digits. February and March, not so much. However, as spring approached, growth in equities began to pick up steam. So we went up again in the spring, leading to record highs in several of the benchmark indexes during the summer months. But by October, that's when everything just went downhill. Volatility began to increase as investor concerns about the impact of a trade war between the world's largest economies was enough to prompt sell-off. So investors got scared and they started selling because of all these tariffs that the president was imposing, sending stock prices lower. So anytime this happens, people get scared and they just start selling. Ultimately, that's that panic effect. And then November was a little better. So we did pretty decent in November. But December proved to be tumultuous, to say the least. Ultimately, the benchmark indexes, they just could not match their 2017 year in values. I mean, they just went downhill. In fact, several of the benchmark indexes suffered their worst annual losses in many years. And I can already tell you NASDAQ, S&P 500, I mean, they did pretty bad. So each of the benchmark indexes essentially fell well below what they ended off in 2017. So let's just do a quick comparison. Compared to 2017, the Russell 2000, which eclipsed to its 2017 close mark by over 13% in September, ended the year down 12%, which is huge. So we were up essentially 13% as of September, and then we ended the year down basically over 12%, which is huge. That's a 25% swing. The global Dow was not far behind, falling more than 11% by the end of December. The large caps of the Dow and S&P 500 ended the year down 5.6% and 6.2% respectively. The NASDAQ, which led the way for much of the year on the strength of tech stocks. So NASDAQ is composed of the biggest tech stocks in the world: Amazon, Apple, Google, Microsoft, Tesla, all of these big giant tech stocks, all in the NASDAQ. Gave all the gains, basically just gave up all the gains that it had and dropped almost 4% below where it started the year. So NASDAQ, even tech stocks, if tech stocks are doing bad, then that means the economy, or not the economy, but the markets in general are doing bad. So that's what happened. Ultimately, there were a bunch of trade tariffs that were being imposed. Investors got scared. They sold stocks. Also, the Federal Reserve was increasing interest rates like crazy. They hiked 4 times in a year. So that ultimately caused investors to panic and ultimately sell. So that's the equities or the stock market in general. That's what happened. That's the reason why stocks were down. We can use this information to, make decisions in the future. I would say December of last year in 2018 was probably one of the best months to buy stocks because they were down so much. You could have made a lot of money had you just bought in December and you sold in January this month. Of course, nobody knew that for a fact, but as we all know, what goes down must come right back up when it comes to the markets. So basically, things were on sale or relatively on sale compared to what they've done. So December was definitely a great month when it comes to buying stocks. Now let's talk about the bond market a little bit, which we don't really focus on. But as stock prices soared during the first half of 2018 and interest rates moved incrementally higher, the demand for long-term bonds was marginal. Yields on the 10-year treasuries rose almost 30 basis points, so basically 0.3%, in January as bond prices fell. So anytime interest rates increase, bond prices go down. There's an inverse relationship. Long-term bond yields continue to climb, reaching 3% in January, which makes sense because the Federal Reserve increased interest rates. However, as volatility increased for stocks, the yield on long-term bonds began to fall as demand drove prices higher. Ultimately, the yield on a benchmark 10-year treasuries closed 2018 at 2.68%, up from the 2017 closing yield of 2.41%. So not that much of an increase, but it's better than nothing. Now let's talk about what happened in the oil market. So oil prices began 2018 at over $60 per barrel and continue pushing higher through January, reaching almost $70 per barrel in May. So they were, increasing a little bit. Now ultimately what else happened is that oil prices remain in the $60 range for most of the fall, but then they spiked to almost $76 in early October. But fears of overproduction began pushing oil prices lower in November. Prices continued to fall, hitting a low of nearly $42 per barrel in mid-December. It went up, and then it basically just went right back down. Ultimately, oil prices closed 2018 at $45.81 per barrel. I mean, that's a huge drop. their first annual loss since 2015. As oil prices rose and fell, so did prices at the pump. So if you haven't noticed, gas prices are down. I personally was going out to get gas today, and I seen a pretty low price out there. You can pretty much get premium gas nowadays at the price of economy gas, compared to when, let's say, 2 years ago. So that's huge right there. So ultimately, retail regular gasoline prices. Here's to put some numbers in perspective. Retail gasoline prices close the year around $2.32. That's pretty low per gallon on December 24th, which is about 15 cents less than a year ago. So not that big of a difference if you think about it, but I think it's a difference enough to actually note it. And now let's talk about interest rates. We just talked about this extensively, so won't talk too much about it. But ultimately, the Federal Open Market Committee, or FOMC for short, raised interest rates 4 times during the year. So the Federal Reserve basically raised interest rates 4 times throughout the year. Each time, the target range increased by 25 basis points. The first increase occurred in March, followed by a rate increase in June, an increase in September, and then they actually did go ahead and bump it up in December as well. For the year, the target range has increased 100 basis points from 1.25% to 1.5%, all the way up to 2.25% and 2.5%. Following each rate increase, the committee expressed the expectation that the labor market would remain strong and the economy would continue to expand, while noting that private business investment had slowed. The committee changed its stance by the end of the year and reduced its forecast from 4 rate increases in 2019 to only 2 25 basis point increases in 2019. So let's talk about this for a second. The reason why they're doing this is probably because they're afraid or they're scared that the fact that the stock markets went down, that's very concerning. That's the first time the stock market has gone down in about 9 years or so. So to them, that's pretty scary. I mean, literally, the Federal Reserve does have a lot of power when it comes to how stock prices move. If they continue to increase interest rates, investors will get scared, and ultimately stock prices will keep going down, which I'm pretty sure they don't want. They don't want investors to start being scared, sell off, and everything just going downhill. So, it's very important to note that they're not as aggressive anymore because of the fact that the stock market went down. So it's something that they're very, very cautious of. If you know the Fed, you should know that they're very, very conservative. And the fact that they increased interest rates 4 times last year means that the economy is doing pretty well. Now let's talk about currencies a little bit. The dollar maintained a relatively strong position throughout much of 2018. The Wall Street Journal Dollar Index, which measures the U.S. dollar against the currencies of 16 other countries, closed the year, or 2018, at $89.67, up from its 2017 year-end mark of $85.98. Another currency index, the ICE U.S. Dollar Index, which measures the dollar relative to a basket of 6 foreign currencies, closed 2018 about 4.5% higher, its best annual gain in several years. So currencies were doing pretty good. I guess the U.S. dollar, not the most important thing in the world to know. Now let's talk about gold a little bit. So here's the thing with gold, and a lot of people argue against this. So when the market goes up or when the market goes down, gold usually goes up. So let's see what happened. The market went down, right? So let's see if gold actually went up. So through the first quarter of 2018, gold hovered around $1,350 an ounce, or a troy ounce, they should say. Rising interest rates, favorable stock market returns, and a strong dollar helped to push gold prices lower during the summer months. However, as stock prices faltered, gold prices pushed closer to their early year values, finally closing 2018 at $1,284.70. Wow. So ultimately what happened was that gold essentially, gold basically was up and then it ultimately ended up down. So it did not close as favorable as we wanted it to. So the inverse relationship not always holding true, but it's usually the case that if gold goes up, stock prices go down. If gold goes down, stock prices go up. There's a lot of debate when it comes to that. But let's talk about the economy as a whole. At least through November 2018, December results have not been released yet. But the U.S. labor market was solid throughout 2018. Employment growth averaged 209,000 new jobs per month in 2018, compared with an average monthly increase of 174,000 new jobs in 2017. So essentially, we started producing, or we started getting more jobs out there in the economy. Now remember, one big reason for this just may be they call it the Tax Acts and Jobs Act, or Tax Cuts and Jobs Act, which the goal of the Tax Cuts and Jobs Act, the goal of that was to cut taxes and ultimately create more jobs. So nobody really knows if this has to do with it, but I'm pretty sure it has somewhat to do with it. But the unemployment rate ended the year as of November 2018 at 3.7%, lower than the 4.1% rate at the close of 2017. Over the year, the unemployment rate and the number of unemployed persons declined by 0.4% percentage point and 641,000 respectively. According to the Bureau of Labor Statistics, there were 6.0 million or 6 million unemployed persons in November 2018, down from 6.6 million unemployed in November 2017. So we're doing pretty good when it comes to the unemployment rate. The labor force participation rate was 62.9% in 2018, up slightly from last year's of 62.7%. The employment to population ratio was 60.6%, slightly better than 60.1% in 2017. 2018, the average work week was 34.4 hours. It was 34.5 in 2017. So average hourly earnings in 2018 were $27.35, an increase of 3% or 80 cents over $26.55 in 2017. Now let's talk about GDP, or gross domestic product. So what happened with gross domestic product, or GDP, is that economic growth as measured by gross domestic product, or GDP, expanded throughout the year, increasing at an annual rate of 3.4% in the third quarter of 2018. The first quarter rose 2.2%, followed by a 4.2% gain in the second quarter. So as you can see, there's a lot of different factors that goes into the markets, or that goes into the economy as a whole. But overall, what happened in 2018 is that GDP ultimately rose. So GDP rose, or GDI, gross domestic income, rose 4.3% in the third quarter of 2018 compared to 1.3% in the third quarter of 2017. So ultimately, we did pretty good when it comes to the economy. Now let's talk about inflation a little bit. So inflation, as it relates to consumers, had reached the Federal Reserve stated target rate of 2%, only to fall below that level in November. The Personal Consumption Expenditures, PCE, price index, which is the measure of the increase in the price of goods and services purchased by consumers, was 1.8% higher in November 2018 compared to November 2017. So there's a lot of different things when it comes to inflation. For example, after-tax income, or disposable personal income, increased 4% in the third quarter of 2018 after expanding at an annual rate of 4.4% in 2017. Just a lot of different things. Now let's talk about the housing market. There was a lack of inventory, which was the case in 2017 as well. But a lack of inventory coupled with rising mortgage interest rates contributed to a rather very lackluster performance in the housing sector. So the real estate economy even went through it last year. Through November, existing home sales are down 7% from a year ago. That's huge. The November annual sales rate of 5.32 million was notably lower than the 5.72 million rate for November 2017. The median existing house price for all housing types in November was 257,700, up 4.2% from November 2017. So we sold less homes, but we sold them at higher prices. But November's price increase marks the 81st consecutive month of year-over-year gains. So we're still doing pretty good from a price standpoint. We're just not doing so well from a volume standpoint, which could be the fact that there's a lack of inventory. But in 2019 we have seen, it's picking up a little bit. But total inventory of existing homes for sale in November were 1.74 million, which is 4.2% greater than what happened in 2017 of November. And let's talk a little bit about, manufacturing. So new orders for capital goods increased by 8.5%, and shipment of capital goods expanded by 7.3%. There are a few other things, but we won't really get into that. Let me just give you guys a quick summary of what to look out for and all that good stuff. So the economy grew at a respectable rate in 2018. The economy did well. That we cannot argue with. The economy did really, really well in 2018. Now, will it continue along the same path in 2019? I would say there's a fear of economic slowdown, which ultimately happened at the end of last year, which also may be realized at the beginning of 2019. The housing market hasn't picked up the pace and is generally lagging behind other economic mainstreams. Also, with inflation inching ahead, economic stimulus may be easing, which could lead to a tighter financial conditions moving ahead. Certainly, if the global trade wars between the United States and China continue, not only will the impact be felt domestically, but a rift between the world's two largest economies, the U.S. and China, is sure to affect global economies and markets as well. And as 2018 closes and 2019 begins, the federal government still remains shut down. So that's just a little bit when it comes to the markets as a whole. So that's like basically everything that happened in the markets. Just to recap, the economy did well. The stock market didn't do so well. The economy went up a lot. The stock market went down, to me, quite a lot. So what that does is it creates opportunities for investors. For example, if you knew that in December, you could have bought some stocks, just sat on them, and perhaps you just sold this month, you would have done pretty well. Or if you just held them, maybe you held them until the end of the year. Who knows when you decide to hold them. The point is, there's always opportunities in the market, whether the markets go up, whether markets go down or whether they go up. There's always opportunities to buy and sell and to make money. So we have to take advantage of these different opportunities because the market is here for us. It's not here for anybody else. It's here for us. It's here to stay. You can buy stocks for very, 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 very little money nowadays. So if you haven't invested, I would highly recommend that you at least consider it. Consider investing because ultimately that's how money grows. Money doesn't just grow if it's in a savings account or in a bank. Money has to grow by investing it. That's how money grows. Money grows only when we invest. So one thing that I would say is that with all these things going on, stock market going down and all this and that, you at a minimum want to participate in all this stuff. I know we had a bad year in 2018. I'm still very optimistic about the market, especially in 2019. I think 2019 is going to be great, minus everything that's going on in the government right now with the government shutdown. I think 2019 is destined for greatness. I think we're going to do well as far as the stock market, the economy, all that good stuff. I don't see a recession within the next 2 years or so. I certainly don't see a recession in 2019. But who knows? I think a recession is coming within the next 5 years, and it's probably going to be a bad one. But the good thing is there's what caused a recession, which is basically lack of regulations amongst the banks. Banks just loaning out money to anybody, and basically just causing the housing housing crash. I don't really think that we're going to go through that a lot, just because there's a lot of regulations going on. Um, they were saying that they're looking to deregulate some of this stuff, which could be the cause of it. But I still am very optimistic about the market, at least for the next 2 years, at least through the end of 2020. Anything after that, I don't really know, but I think 2019 we're in pretty good shape. There's not a whole lot to worry about. So if you're not an investor, I highly encourage you to at least consider it. Always get educated on the markets. Look at reports like the ones that I've just read. Talk to experts. Try to hire, potentially an advisor. There's a lot of different things you can do when it comes to this stuff. But I would say, at a bare minimum, you at least want to consider becoming a part of this stuff, because I would hate for you to be missing out on gains and even opportunities to buy stuff when they're down. So it's very important to become an investor, just because when it comes to inflation, for example, they just talked about inflation 2-3%. If you're not investing your money, ultimately you may be losing. Or let's say your money is sitting in a bank collecting maybe 0.5%, and inflation is 2%. In a few years or so, or not a few years, but in, let's say, 20 years, 30 years, if that money is still sitting in the bank, it's actually losing money, because your money is making less than inflation. Inflation is the diminishing purchasing power of your money, essentially, or the increase in the cost of things or items that you buy. For example, if you're buying clothes, if you're buying food, all these things get expensive every year because of inflation. And you just seen that the economy did really well. So it makes a lot of sense why things are becoming more expensive, because the economy did well, people made more money, people bought more stuff, people spent more money. So with that being said, there's really no reason for them not to push up prices. So with that being said, you have to continuously invest your money. You have to consistently watch the market, pay very close attention. You don't have to watch it every single day, but at a bare minimum, maybe once a week or so. So very, very important to keep all these things in mind, is that the stock market is for us. It wasn't built for anybody else. And I would highly recommend or encourage you to at least consider participating in the market. It doesn't just have to be stocks. It could be bonds. It can be real estate. It can be cryptocurrency. It can be anything, but the point is you have to invest in something, because that's the only way to make money. The best type of money is money you make when you sleep, not necessarily money you make when you have to work. And as my mentor, Warren Buffett, said, if you cannot make money in your sleep, or if you don't know how to make money in your sleep, you'll be working for the rest of your life. So thank you all for tuning in to WJC 98.3 FM, your voice, your music, your station. My name is Jeff Badu once again. I look forward to continuously delivering you all some content. Next week, we'll have a banking specialist who will come on the line and ultimately talk about some things when it relates to banking. We'll talk about the FHA loan, or Federal Housing Administration loan, how you can buy a 1 to 4 unit building with as little as 3.5% down, with as little as a 580 credit score, and a decent amount. Let's say you're making a decent amount, and just a few dollars in the bank or so. You always want to have some money in the bank, but we'll be talking about that, different ways you can buy properties, investment properties. It can truly change your life. This is all life-changing things, something that has helped me a lot. And so I would highly encourage you all to tune in next week. We are streaming live on Facebook as well. This will be posted on my podcast. Every segment that I do will go on my podcast, my website, my YouTube page. And sometimes it turns into an article as well. But I encourage you all to continuously tune in, just because, for one, we're in the stock market right now that's very volatile. So we want to continuously pay attention. We want to look at the trends. And most importantly, we want to participate as well, whether the markets are up or whether they're down. We always want to participate. So thank you all for tuning in to WJC 98.3 FM once again. And I look forward to continuously delivering you all some content. Thank you.
Le shogun de Bamenda, famille photo.